Hello and welcome to this Wednesday. Monday. Getting my weeks mixed up. Monday, March 28th, 2022 edition of Trading Places live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Hopefully everybody had a good weekend. We are getting close to the end of March. This is when normally the market tends to head higher in anticipation of money coming in. But we've seen the market make a pretty big move. So that's going to add one more dynamic to everything that we've been trying to evaluate here in the market. Currently, we do have futures. They were down overnight, then they came back, went positive. Then the last time I looked, maybe 5 minutes or so, they were back near the flat line. I'm just going to pull up the QQQ here. Give me 1 second to see where the NASDAQ 100 is set right now. Actually, it's up about 17 cents, which is about 0.05%. So we are going to be pretty flat at the open. The Dow is actually on the other side, down 33 cents, so down 0.09%. And then we have the spider also at that same 0.09% down level. So pretty close to the break-even point. Not really going to see a whole lot here at the open. But again, this is when the market normally begins to anticipate the funds coming in from the various 401ks and pension funds and so forth. So normally you got portfolio managers moving into stocks in anticipation of that other money coming in. That's historically what's happened in the market, but it doesn't happen every month. So just one more dynamic to add into the picture. Let's see, before we get going today, let me go ahead and take everyone over to our homepage at Earnings Beats. If you're new to Earnings Beats, we'd love to have you join our Earnings Beats Digest community. This is our free newsletter. Published an article this morning talking a little bit about, what we should be looking for if the market does roll over, where are the key support levels and so forth. A lot of times this newsletter is just simply talking about an individual stock or an industry group, maybe pointing out relative strength or an earnings gap, candlesticks, different patterns. We try to make it very educational. It's a 3 times a week newsletter, and there's no credit card required. You can unsubscribe at any time. It's a free, completely free newsletter. So we'd love to have you. Simply type in your name, email address there, hit the subscribe button, and we'll get you set up. Also, anyone who is on this newsletter and is part of our community, we reach out to when we have free events. We had a really good one last week, and I'm sure you can take a look at the recording. If you don't have a copy, you can write into us at support@earningsbeats.com. We'll make sure we get you a copy of it. But it was a great event, just really taking a look at everything that's been transpiring in 2022 and what it could mean. And then this week we actually have another event. This is for our paid members, but we do have a free 30-day trial. So if you'd like to come in, check this out. You can sign up for it with you do need a credit card, but that'll be a 30-day free trial. So for the next 30 days, it's completely free. And at the end of your trial period, we'll reach out to you and let you know that you are expiring. I know personally for me, I don't like signing up for some of these, I always forget, and then I get charged. We're not going to do that. We'll reach out to you and make sure that you do know that you're coming up for a renewal. But anyway, first 30 days free. And this is the event that we're going to have this weekend or this Wednesday for our members. So it's Wednesday, March 30th, 2 days from today, 4:30 p.m. Going to talk about the resumption of a secular bull market. I'm not sure where we are right now, to be quite honest. I don't know, if we're ready to resume this secular bull market. If you are a member, back on January 8th when we had Market Vision 2022, I talked about the market going down and then bouncing back up. The only question was, how deep would we go? And I said my minimum downside target was 4,300 on the S&P. And this was back when we were 4,800. But I thought maybe we could get to 4,300 minimum. And then maximum, I really thought maybe 3,500 to 3,800 could come into play. And with the market rebounding here of late, it's actually starting to look much more like sideways consolidation. I'm not ready to go there just yet. But if the S&P clears 4,600 on this move to the upside, it's really definitely beginning to look like sideways consolidation and no more downside. That doesn't mean we won't go down and retest. I'm talking about no more new lows. So the question for me at this point is, are we looking at more consolidation over the summer, into the spring and summer, or could we possibly see another leg to the downside? Well, we're going to have you ready for either. We talked about the downside. We've been talking about the downside. This is more about, what if we break out above 4,600? What should we be thinking about? I mean, one thing you can't do, and I wrote about this, and I'll show you my blog article in just a minute. What you cannot do is come to a conclusion that the market's going to go lower and then stick to your guns no matter what. That's one of the biggest mistakes that I think traders make, is that you get this preconceived notion as to which way the market's going to go, and then that's it. It's got to go there. If it doesn't, then you just, the market's wrong. Well, you can miss out on a lot of upside by doing that. So I think right now we need to watch to see the various steps that would suggest to us that we are resuming that secular bull market. You might say, well, we already are. Look at what we've been doing. Well, we haven't taken out any key levels yet. If you've seen cyclical bear markets before, and you could go back just to 2020 was one, that was pandemic, but 2018 was more of a normal cyclical bear market, 3 months, 20%. You have these rallies, you get 8, 10, 12% rallies, and then the next shoe drops and the bottom falls out of the market. So you got to be prepared for that to the downside. There are certain signals, though, that'll tell us we're probably not going to get that kind of a move back to the downside. And that's part of what we'll be talking about here, but also leadership. You've got to be prepared. You can't just say one day, oh, the market's breaking out, let's just go into this or this. You need to have a game plan in place and prepare for it. And that's a lot of what we're going to be talking about. So, make sure you understand what that typical leadership is, where you want to consider being, and what to look for. In other words, once we break out, we're going to have a pullback inevitably, but where would that pullback come back to? Where would be the best place to consider entering on the long side? All those things I'll be talking about on Wednesday. So hopefully you can make it. Again, it does take a trial membership at least. So if you're not a member, you can just click right here on this start your no cost trial and get everything set up, and you'll be good to go. All right, let's move on to the action from Friday. And when you look at there are definitely some bullish signals on these charts. I've been talking really throughout the entire 2022 how the AD lines continue going higher. We're in new record high territory on the AD lines on the Dow, the S&P, and the NASDAQ. And look at mid caps and small caps all of a sudden, catching fire again. So what this tells me is, even if we do go lower, this market is being bought up. This is not what we would see in a secular bear market. In a secular bear market, we would have distribution, and we would be seeing huge moves lower in the AD line when we would drop. And then when we would rally, you'd see little bumps, if any, back to the upside. This is different. So there's a lot of folks still buying this market. And the fact that we've got AD lines breaking out to new highs, that's a pretty good sign that this is nothing more than a cyclical bear market. A lot of folks want to say, no, there's so much going on. You point to all the news stories. Well, the news stories are great, but news stories are not going to direct the stock market. Stock market's going to do its own thing. And a lot of times the stock market's looking beyond the current news stories. It's looking down the road, things that we can't see right now. We're so clouded by the media noise that's always out. We have no idea. We just don't know how to get past that to look to see what Wall Street sees. But all this action, moving back up is one thing, but AD lines moving to new highs, that's a pretty big deal. Anyway, Dow Jones up 153 on Friday, S&P up 23, NASDAQ down 22. So a little bit of a bifurcated market there. Mid caps were up 19 though, small caps up 8. So on a percentage basis, we had the mid caps and small caps leading us at the end of last week. And if you notice, we're trying to break out here above the February high on the mid cap. Small caps have already done it. We already broke above the February high, pulled back at the 20-day. And we're going to take a look at this index in just a minute, but this is a pretty bullish looking bounce off the 20-day. So there are some things setting up pretty well here. When you look at the Dow Jones, however, we haven't gotten back to the February high. Same with the S&P. There's that double top, 4,600. That's what I'm talking about right there. If we can get that move through 4,600, and maybe what we're seeing in small caps and about to do in mid caps, maybe that's telling us that we're going to get that breakout. NASDAQ got this double top right here at around 14.5. Need to break through that. If we start taking out these key resistance levels, and you've got 20 days that cross back up above 50 days, we get these golden crosses, and you've got price action above the 20-day, which is above the 50-day, you need to start thinking about the possibility that we're not going back down. Or again, we're not going to new lows. A lot of times when you get these crosses back and forth on moving averages, it can be whipsaw, it can be consolidation. So you get a lot of false signals. So that would probably, I mean, if we break out above 4,600 here and 14.5 here, I would say probably worst case scenario, instead of 3,500 or 3,800 on the S&P, I would up my worst case scenario, maybe just to retest 4,100. That would be my downside limitation. Looking at the sectors, energy leading again on Friday, up more than 2%. I think we did close at a new high, but definitely challenging the intraday highs that we saw earlier in March. Utilities making a big breakout over 72. Financials above the moving averages, also up about 1.25%. Still in this downtrend though, lower low, lower high, lower low, lower high. That's what defines a downtrend. So we're still in these, and that's why it's so important for the S&P and NASDAQ to take out these highs, because right now we've got low, reaction high, low, reaction high, but we haven't taken out this high. So we could roll back over and go to a new low, and we'd still have that lower low, lower high, lower low, lower high, lower low pattern in play. So 4,600 is a big level, something we need to watch. All right, on the, to the downside, the only two groups that lagged on Friday, and this is somewhat noteworthy, discretionary and technology. They weren't horrible. They're now above their 20-day, and their 20 days rising, getting close to the 50-day, but they were down on Friday. They did not participate. But if you notice, look at their AD lines. Look at the discretionary AD line. Breaking out to a new high. Technology, new high. It's not looking nearly as bad as maybe the price action would tell us. And I think that, again, is painting a picture of a secular bull market that is set to resume. Whether it's resuming now or not, that's not really what it's telling me. It's just telling me that there are plenty of buyers on Wall Street for all of the weakness that we've seen in the past few months. All right, 10-year Treasury yield. Let's get a quick update here. As far as economic reports go, we have a lot of economic reports coming out this week. Not so much today, but let me give you a list of some of the things we'll be looking at later in the week. So tomorrow we've got the Case-Shiller Home Price Index, the FHFA House Price Index, Consumer Confidence, all that's out tomorrow morning. Wednesday, ADP Employment Report and the GDP. I think that's the second reading of Q4 GDP. And then we've got Thursday, jobless claims, personal income, personal spending, Chicago PMI, and then Friday, non-farm payrolls, PMI manufacturing, ISM manufacturing, and construction spending. So we got a lot of economic reports out later this week to see exactly where we stand in terms of the economy. All right, looking at the 10-year Treasury yield, 2.46%. And what I did on this chart today is I added the IWF versus the IWD down here at the bottom. This is large cap growth versus large cap value. And what's interesting is that normally, you see how rates were going up? And that kind of is when this growth versus value peaked and has been going down. Well, notice what's happened here over the last 3 or 4 weeks. This is what's been really crazy, is that we have seen a move back up in Treasury yields, a very steep move, 170 to 250. And during this period, large cap growth is outperforming large cap value. Now, remember when rates were going up and the media was all over the fact that growth stocks were getting hit? It was so bad for growth stocks because rates were going up. I mean, it was all over the news. That's all they were talking about. And I kept saying, well, it is bad in the short term, but we still have very, very, very low interest rates. It's still not a bad thing for a growth environment to have a 10-year Treasury yield at 2.45%. But where's the media? Why are we not talking about this? We've had Treasury yields go from 170 to 250. It's more than a 50% rise in Treasury yields in the last 3 weeks. And growth stocks are outperforming value, and you don't see a thing about it. Now, if all of a sudden growth stocks next week take a tumble, it'll be about higher interest rates. It's just the way it works. Just, I mean, can't make this stuff up. Anyway, yeah, I don't see anybody talking about higher rates and how they're killing growth stocks right now as Apple rebounds, Microsoft rebounds, Tesla rebounds. By the way, Tesla came out and made an announcement. They're going to have another stock split. Stock last time I looked was up $50 pre-market, back up to about 1,060. And you know, the other thing with Tesla is we do tend to see pre-earnings reports run-ups in Tesla shares. Of course, they report at the end of April, still 4 weeks away, but maybe part of this is, you know, folks starting to jump in because of earnings. But anyhow, Tesla did not announce the details of the split. They just said that they want to get the board to authorize more shares so that they can split. So there's no announcement as to, you know, what they're going to do. But I think Elon Musk said that they want to pay out a stock dividend. So anyway, for what it's worth, Tesla doing really well this morning. All right, let's move on and talk about small caps. So I mentioned the small caps making this nice little bounce off the 20-day. Well, you can see the 20-day coming up. We've got this nice golden cross. The 20-day is now climbed above the 50. We haven't seen this yet on the Dow, S&P, and NASDAQ. This is just the small and mid caps that are doing this. So we're starting to see a little bit more momentum in these groups on a relative basis. And here was that AD line, not quite to the highs of the last year, but definitely heading in the right direction. You can see as we've moved up to new highs over these price lows, or excuse me, the prior price highs, you can see the AD line also moving up to new highs. So this is really good action coming down, bouncing off the 20, moving up. PPO's gone positive. So now we've got positive momentum. You know, in the past, maybe last 6 weeks or so, 6 to 8 weeks, see how the AD line was going up? We weren't really going anywhere. We're going sideways. What it meant was simply that this selling momentum, which was strengthening, just began to slow. So the PPO moving higher in negative territory, a lot of times that doesn't mean anything positive. That drives me crazy with technicians. They say, oh, you know, PPO's turned up and crossed the trigger line. Well, it can, you know, it may evolve into something, but a lot of times all it is that slowing momentum is selling, or selling momentum is slowing. Let's do it that way. So you've got selling momentum, which is just absolutely exploding here. That PPO is just, you know, cratering to the downside. And then we just go sideways. In this right here, we had gone absolutely nowhere in 3 or 4 weeks. Yet you can see the PPO made a big move up. That's not really telling us anything. What gets my attention is once the PPO crosses the center line, because now what that's telling me is that your 12-period EMA is going, you know, is pulling away from your 26-period EMA. It's higher than the 26-period and it's pulling away from it. That is the definition of increasing bullish momentum. So as long as we continue to trend above the 20 and the 20 trends above the 50, I think small caps now are in buy territory. This is a group that, you know, we haven't really seen much since November. It's been mostly down. You know, could it be a head fake? Sure. I mean, we saw one of those back here at the beginning of the year. Went down, came back up, took out this prior high, just like we took out these prior highs. But once it goes back below the 20-day, and once the PPO goes negative, there's no reason to hang on for dear life. I mean, that's the definition of when I would be getting out of a trade. So looks good, but we're not out of the woods. I guess that's probably the best way to put it at this point. How about the mid caps? Mid caps, pretty much same chart. I mean, I'm not seeing a whole lot. The only big difference is that we haven't yet cleared the February high. We went up, tested it, pulled back, held the 20-day, and now we're starting to turn back up. PPO looks good. 20's crossed above the 50. Definitely looking much better. A breakout above 27.25 is a very bullish breakout on this chart. So I think mid cap's looking pretty good there. Okay, wanted to take a look at the relative strength of sectors. You know, I do this a lot just to see when the market's starting to rally, you know, where's the money going? What groups are leading? So we're starting to see technology, this XLK versus the SPX, the S&P 500. over the last 5 years into a weekly chart. Now you can see we topped on a relative basis in technology back at the beginning of December. And I think you could still argue that we are in a downtrend. I mean, yeah, we bounced so far in March, but the overall move to the downside still seems to be in play. This relative PPO is below the center line, still really not bouncing much to the upside. And then down here is your actual price chart of the XLK. And we had a nice little trend line that was in play. We broke, back at the beginning of the year. So there's still enough here to be concerned about the rally. I wouldn't say that, I believe the market's going to fail. I would say until we pass 4,600, that probably, excuse me, if I had to put odds on it, I'd probably say 60-40 that we don't go through 4,600. But I'm open to the possibility we go through. I'm open to the possibility this secular bull market just resumes again. You would think with all the negative news out there, that wouldn't be the case. But I'll show you something in just a minute. One of my blog articles I wrote over the weekend. You got to be careful looking at the news and trying to base what you think the stock market should do based on what the news is going on right now. Because the stock market doesn't price based on the news today. It prices based on the news in the future. Anyhow, if we get a breakout on the S&P above 4,600, yeah, I want to see technology really starting to turn back up here. That's a group I want to see lead. Consumer discretionary. I mean, you look at this, we just moved to about a year and a half, maybe year and 3/4 low, almost 2-year low. Beginning of March, let's see, this was back beginning of May. So yeah, about 22 months ago, we hit this relative low. So consumer discretionary has not been performing well, but what's interesting, like I showed you on the opening screen, the XLY is putting in a new high on its AD line. Pretty crazy when you look at the relative strength, you look at the relative weakness, I should say, and the absolute weakness that we've seen in the group. But it is starting to come back. Just the question is it going to lead? If the market bounces and we're not getting leadership, well, actually, that's technology. I don't know why that did that. Let me change that to XLY. Yeah, because that's been weaker. There we go. Yeah, XLY has been much weaker than XLK. Now, we are seeing a bounce back, and we are seeing a little bit of relative strength. But do we roll over? Can we get back through this reaction high, the January reaction high at 185, 184? Can we do that? Can we break back up above these moving averages? Can consumer discretionary begin leading again? I don't want to see a market going up where consumer discretionary and technology are lagging and rolling back over again. That is not the kind of market that I would feel very confident about. Doesn't mean we can't go higher. Market can do anything it wants to do. But I wouldn't feel very confident in that move if we're not getting leadership from consumer discretionary and technology. All that's telling me really is that as we go higher, the market is simply, Wall Street simply rotating more into defense on the rally. So got to be careful. Got to watch these relative strength areas. How about the other consumer area, consumer staples? Well, consumer staples has been very strong this year, but during this rally, latest rally, it's pulled back. So we have seen that XLY begin to show some strength in March and the XLP pulling back. So that relationship is good because I always like to look at the XLY, XLP. One of my favorite ratios. And here's what I'm talking about. Here was that big move down. Market really struggled. Now, as we rally back, we've been seeing some pretty good strength. Does it continue on a breakout? First, we got to get the breakout, and then we look at relative strength. It's not the other way around. I'm not looking at this saying, oh, we're going to break out because consumer discretionary has been leading. That is not the way I look at it. This is the secondary indicator. It's a strong secondary indicator, but this is a secondary indicator. Primary indicator is just the price chart itself, the S&P 500. Nothing is more important than the price action going on there. All right, let's take a look at some articles I have written here over the past week or so. Talked about the FANG stocks, wondering is the bottom in? I mean, we're going to need some support from the FANG stocks if the market's to go higher, because these stocks are all so heavily weighted in the index. So this was from several days ago. So some of these charts have changed. Obviously, the market's been rebounding, but this was Facebook. I highlighted, where it had been the first part of the year to what it was doing here in the last week or so. You can see it was getting a nice rebound. And then we went into Apple. Apple, by the way, now has broken out of this channel. So that's a good thing. That's a positive you can certainly take away. Amazon's been very strong. I think it's still sitting right around that 3,300 level, maybe just a little below. But Amazon, after really being hit hard first part of the year, has come back very strong off of those lows. So that's good. Still needs to break that trend line. I haven't looked at that in the last several days, so I'm not sure if it did make that break or not. I don't believe it did, though. It did get back to a new 2022 relative high versus the S&P, though. Pretty interesting. Netflix, kind of like Facebook, been under a lot of pressure. It got a little bit of a bounce, but you can see the difference in the bounce there versus Apple and Amazon. Google, pretty strong. We went down, put in this double bottom at 2,500. It's been rallying back pretty nicely. Microsoft, and by the way, I added Microsoft and Tesla to the FANG. So if you're wondering why Microsoft is in this FANG article, I think it's probably more important than some of the other FANG stocks. Anyway, Microsoft did make this breakout. So starting to see some relative strength there. And then Tesla, like I said, is now up to about 1060 this morning with the split news. So it continues to perform really well. Look at Tesla relative to the autos. It's still a leader. And that's one of the things I think is really important to look at. I think it's great to own great companies, but especially if they're leading their peers. It's always a good sign. Anyway, so that was one article. Then I also wrote about two charts I think we need to kind of keep in mind, as we're moving up here and challenging this 4,600 level on the S&P 500. Notice the equity only put call ratio falling again. The last two times we've been in this range or lower and bottomed right here at the end of December, right here first week of November. Look at what happened to the market. Here, we never really went back. Here we went above intraday, but really never got above that level and ended up falling. Here, slight little move above, but then we ended up falling. So the question is, are we, in an area where we're about the top? Now, we did come back up on Friday, and we got a little bit more room, maybe 1% or maybe somewhere around there, up to that 4,600 level. But is this telling us something? Or do we need to go all the way back down here to the 0.40? I'm not sure. Maybe we're going to go to the 0.40 and we'll get up and have a false breakout over 4,600 when this drops down here. I don't know. Just wanted to point it out. I think this is a really important chart. So that's one chart to watch. The other chart, and I point this out a lot to our members, the QQQ last week, this was on Friday, going higher and higher and higher. Consumer discretionary had rolled over versus consumer staples. Transports were horrible relative to utilities. Growth versus value started to break trend lines. Both these charts did. And then mid-cap growth versus mid-cap value going down, small cap growth versus small cap value going down. Look at the breakdowns on Friday. This is when the market's still going up. So these are secondary indicators, but they don't make you feel very good about the rally when everything seems to be starting to turn more defensive. This is something we need to watch this week. It's going to be really important. Then the last article I wrote yesterday, and this is what I was talking about earlier in the show, where sometimes you get so clouded and jaded by the news that's coming out right now that you can't think past it. You think, my gosh, things are so bad. Look at what gas is doing, crude oil prices and interest rates are going up. And we got this war over in Russia-Ukraine conflict. And, inflation that we've got to deal with that's been spiraling higher. I mean, how could we possibly go higher? Well, I just wanted to point out in 1990, 1991, the Persian Gulf War, we had all those same things, everything, just like we have it now. Look at crude oil prices, went from 17 to 40, 147% spike in 4 months. And guess what? 4 months later, it was back down to 17. Look at the market. There's your 20% cyclical bear market. 4 months later, we were back at a new high. We can't get consumed by the news. We have to pay attention to the technicals. So watch, learn from history. These cyclical bear markets tell us a lot if we just study their charts. Just because the market's going down and just because the news is bad out there, and maybe the news gets even worse, this red shaded area right here, this was a recession. The recession didn't end until late March of 1991. By then, the stock market was at an all-time high. If you're waiting for the recession to end, if there is one, I think there could be one, but it's weird though, because we've still got really good employment. So that's the thing that is kind of weird about having a recession now. And then look at these vertical dotted lines right here. This is when the Persian Gulf War started. This is when it ended. Shortly after it started, the market bottomed. And by the time it ended, the market was at an all-time high. So if you're sitting back and you're looking at all the news, you're probably going to miss out on some pretty good opportunities in the stock market. You're not going to believe that the market can go higher. So anyway, we never went back down to that level on the S&P, by the way. Just kept going higher and higher. So if you're waiting for the retest, you're still waiting today. We never went back to 300. All right, let's go ahead. There's not really much in the way of earnings news, so I'm just going to skip earnings today. Let's just look at the three you must see. The market just opened. The three you must see, I just wanted to point out a couple of names that, were big names the last couple of years, or two of them anyway. And they're starting to regain strength again. GameStop, looked like GameStop had made a big breakdown right here. Isn't it crazy sometimes how the stock market works? That's probably when I would have thrown up my hands and said, that's it, I can't take anymore. And right from 80, we've gone up, almost doubled here in about two weeks. We've now gone 9 straight days with closes above the open. 9 straight days, all these hollow candlesticks. Look at the AD line taking off. All of this occurred after it looked like GameStop was just basically done, breaking down, and then it comes roaring back. Sometimes the market's not really fair. Tilray. So it's another one that's all of a sudden catching fire. Down today, though, down 8%. But it should have some pretty good support around that gap support zone, maybe around $7 if it gets back down there. We'll see whether or not that holds. A lot of volume coming in, though, in these past couple of days. Don't be surprised if we do make another run to the upside. But you're going to have to be willing to take a lot of risk. It's hard to get into Tilray or any of these stocks after they make these big moves without being willing to take risk. The other one I wanted to mention to you is one that I think I mentioned this one last week, but 114, if we get through, we came back again last week trying to get through. Look at this AD line breaking to new highs. This is a stock. And the main reason I like this, you can kind of look at it on the daily chart and see pretty obviously that 114 is a big level if we can get through. But the other thing I like about this chart is look at the 5-year weekly chart. This is a nice chart. And we've had this very nice pullback. This was a stock that was trading up around 133, 132 4 months ago. Pulled all the way back down below 100. And now these reaction highs are around 114. This could turn out to be a pretty nice little cup off the uptrend. So any kind of a breakout above 114, I'd be looking for a move back up into the 130s. And the fact that it's a nice long-term performer makes me feel even better. And it's in healthcare. So even if the market's weak over the summer, a lot of times money will rotate into healthcare. So this is one that I definitely keep an eye on. I just wanted to mention it again. All right, let's see what the market's doing. We'll wrap this up. All right, Dow down 137, S&P down 8, NASDAQ up 26. There's Tesla up 48. But you wouldn't think growth stocks, right? I mean, the yields down a little bit today, 4 basis points, 2.45, but still, we've been on a tear to the upside on the 10-year Treasury yield. And here we are with NASDAQ, with the NASDAQ leading. Kind of interesting. Now up 42, so making a pretty good move today so far. Anyhow, that's it for me. Everybody have a great day. Remember, we do have that event coming up on Wednesday. So if you want to learn more about how these secular bull markets kind of resume coming out of these cyclical bears, and again, you can say that this wasn't a cyclical bear because the S&P did not technically lose 20%, but I'd point you around most areas of the market where we've lost 20% and more, and say that, yeah, this has pretty much been a bear market, cyclical bear market. But anyway, if you want to learn more about, markets coming out of these and where you should be focused if this rally continues, then the Wednesday event's for you. So make sure you go over to Earnings Beats. All you got to do is click on that no cost trial if you're not already a member. Love to have you. Anyhow, everybody have a great day. Be back tomorrow over at Stock Charts TV. So if you go into Stock Charts, all you have to do is click on the Stock Charts TV at 9 a.m. And that will be the next Trading Places Live episode. And then I'll be back here at Earnings Beats on Wednesday for that episode. Anyhow, everybody have a great day. Happy trading.